Hello and welcome to this fresh new edition of Mutual Fund Corner. I'm Sonal Bhutra and with me is Pavitra Parekh. Well, there have been interesting updates that's happening in the MF industry. We'll discuss that, but today we are going to touch upon direct and regular mutual fund plans. Direct plans have been almost a decade old, right? It was launched in Jan 2013. So it's a good time to discuss about it. Both schemes have been in the market for some time now and they do have their pros and cons. And especially for an investor who's new to the market and wants to maybe switch schemes. So we'll discuss that and delve deeper and understand the dynamics of both the type of funds, right?
Oh, absolutely. It's good to go right back to basics, right? Especially for maybe a new investor that's watching our show. So let's welcome our guest. Then we have Kaustubh Belapurkar joining us. He's Director of Fund Research at Morningstar Investment Advisor. Kaustubh, it's always a pleasure to have you on the show. Thank you once again for taking out the time and being with us. You know, like Sonal was pointing out, direct plans were launched a while ago, right, in Jan 2013. So it's been over a decade now. We've had some time to really see how the performance has been, and we'll get to that in a bit. But first up, for the sake of our viewers, do you want to just take us through what the difference really is when you look at a regular plan and a direct plan?
Sure. Firstly, Pavitra, Sonal, thanks for having me on the show. And I think very important context and, sort of discussion going back to the basics. Like you said, it's important to kind of enlighten investors what these stand for. So when you think about what SEBI looked to do with the introduction of the direct plans and what's the key difference between the two, right? So when you think of the construct of the fund, it's essentially both plans, or would be popularly known as share classes, nationally, they're exactly the same fund, right? I mean, it's the same fund manager, the same portfolio, but there's one key difference in between the two, and that is the expense ratio of the two plans, right? And the direct share class has a lower expense as compared to the regular share class. And the reason for that is there is no distribution commission that is embedded in the direct share class. The regular share class would have a distribution commission attached to it, which would be paid to a mutual fund distributor that you would tend to work with. So I think that's the key and primary difference between the two. All other things obviously remain similar in terms of portfolio and fund manager. And I think very importantly also the investment minimums, right? And just going back in history, before 2013, we used to have a regular share class and an institutional share class. And the NC share class, which was cheaper, was meant for higher ticket sizes, typically your institutional or your corporate clients. SEBI decided to make an even sort of playing field that even the smallest the average investor on the street can buy a cheaper share class. And that's why, the direct share class was launched 10 years ago.
Okay, so, that is the basic difference between the two types of funds. But how does it differ for investors? At the end of the day, do you want to know what the returns they're getting on any investment, right? In terms of net asset value as well, does one see better returns versus the other?
Yeah, absolutely. So, I mean, just intuitively, when we think about it, obviously the direct share class having a lower expense because there's the embedded distribution commission does not exist in the direct share class, would tend to have higher returns as compared to the regular share class because it's the same portfolio, everything else remaining the same, cost being lower, the returns would be higher for or any time period that you would compare for the direct share class versus the regular share class. When you think about it purely from a returns perspective, obviously the NAV will be quite varying, but what's important is the percentage of return that you would derive from that would be higher. Typically, the way investors would look at it, right? So if you're working with a mutual fund distributor who's kind of helping you build a portfolio, you would be investing in a regular share class. And if you're doing it yourself or going through a registered investment advisor or going directly to the fund website or some of the platforms that offer direct share classes, then you would potentially be investing in the direct share class. So I think that's the the other difference that I just want to point out in terms of the way you would be investing in these share classes.
Okay, that's very important to know. Kaustubh, also, let's just try to do a comparison of how direct funds have performed versus regular funds. I'm talking about, say, how they've performed versus the benchmark. I know you do have some data which, spans a longer period. So you want to take us through that as well?
Yeah, sure. So I think the first thing, just in terms of, to alluding to your previous question, what's, if you look at the average differences in returns, right, which is predominantly just driven purely by the difference in expense ratios. So over the last 5 years, the difference in returns between the regular and the direct share class has been anywhere between 0.6% on average for fixed income funds, where the gaps in the expense ratios are lower. to about 1 to 1.2% for equity and hybrid funds, where the expense ratio difference are larger. Obviously, this is the average number. It'll vary fund on fund, but that's the typical average that you would see across the various asset classes, right? When you think about how have these share classes performed versus the benchmarks, and I think SEBI themselves had done this analysis and published it in the consultation paper that they released in May of this year. They've put out some interesting stats. I'm just going to quote some of the stats that they've put out. So what they essentially did was looked at direct and regular share classes separately in terms of returns, and compare it versus the benchmark that the category holds, and looked at what percentage of funds over varying timeframes have beaten the benchmark, right? So what the data showed us is about 2/3 of the direct share class is over a 10-year period have beaten the benchmark. The corresponding number for regular share classes obviously is lower at about 40%. That means about 25, 26% of those funds, probably the direct share class marginally beat the benchmark, and by the virtue of the regular share class being more expensive by maybe 0.5% or more, did underperform the benchmark, right? But I think the other important context to set here, even and the same kind of data you would see over a 1, 3, 5 years sort of horizon, albeit with slightly different numbers, but obviously direct share classes would have a better performance hit rate as compared to regular, purely because they're cheaper, right? But I think the other important thing to also keep in mind is, the SEBI data also drill down into some additional data, and that's important to have that context, right? So when you compare against a benchmark, it's not necessarily an investable benchmark, because the benchmark is purely driven by the performance of the underlying stocks or bonds or whatever the benchmark is holding. It has to be an investable asset class. And that's where they also added another layer of data looking at funds, direct or regular, that underperform the benchmark, all right, but they underperform within a band of 1.25%, right? Because, if you're buying an index fund, there could be a tracking error. There's a cost associated with buying that index fund. So that number, if you add those two, there's actually a reasonable number of both direct and regular share classes that over a 10-year period have definitely beaten the benchmarks. And, I know the active versus passive debate is probably one for another day, but I think the moot point being that, yes, by the virtue of being cheaper, direct share classes are at greater success ratios. But I think broadly as a market, there's still enough scope for active management when we think about it, be it in the direct or the regular share class, across longer time frame.
We were discussing the SEBI table as well, and it was so complicated, but you made it easier for us. And also the active-passive debate, of course, we'll take it up at a later time, Kaustubh. But, let's go ahead with the differentiation here. What is the difference between total expense ratio of regular and direct plans? Do the proposed TR rules also look at clubbing the two schemes?
Yeah. So just taking, the second part of the question first. So direct and regular will continue as is. There's no change that, SEBI is mandating in terms of doing away with either of them. So clearly there's going to be a direct share class. There's going to be a regular share class. They, in fact, might introduce a performance share class. That's obviously up for debate right now. But, these two will remain as is. And like I was sharing earlier, the essential difference is, in the commission or the distribution commission that's paid out. So, if you were just to do the math and, even in the existing TR slabs that SEBI had put forth, the formula essentially, had a base TR plus add-ons to the TR, which was for the regular share class. And then the direct share class TR was to be derived minusing the distribution commission from the regular share class TR. That is the basic math behind it, right? So when you look at the current numbers, and all investors can look at this information, it's available in the monthly fact sheets, where you would see both the direct and the regular share class expense ratios. On an average, again, different for different share classes, for different asset classes, but on an average, I think equity and hybrids, the gap is about 1%. Again, this can vary fund on fund. And for about fixed income funds, it's about 0.45%, right? Again, this will vary fund on fund. But the essential point being that, there is a reasonable gap, and that's important to note, between the direct and the regular share classes in terms of expense ratios.
Okay, got that. That is how these two are different. Kaustubh, we were discussing both of these different categories. Of course, there are advantages with both, but similarly, there are disadvantages with both as well. What do you see as the key disadvantages when an investor chooses, say, a regular plan and then also for a direct plan?
Yeah. So I think with a regular plan, obviously, cost, it being more expensive by the virtue of having, a higher cost, that's probably the biggest disadvantage, so to speak, of a regular plan. But, with direct plan, I think one thing which often gets ignored, right? And I think it's a very important point to address head on. Now, we've seen this resurgence of DIY investors coming to the market and kind of investing on their own, saying, look, hey, this is a cheaper share class, and I can come into this. But see, this is fraught with a lot of risk. At one point, of course, you're trying to save costs by investing into the cheaper share class. But if you're an investor who's perhaps new or doesn't have the time or doesn't have the complete understanding how to build a portfolio, that can be a huge disadvantage, because you're coming in direct, you don't have professional advice that's being given to you, and you could be making financially incorrect decisions, which can actually be much more harmful. So, I mean, you're out to save that 0.5% or 1% in terms of costs, but the impact on your portfolio can be significantly larger, because you took decisions that were probably not prudent for your portfolio. And I'll share some of these studies that we've done in terms of investor returns versus fund returns, and I think it's a very powerful the numbers are very compelling, that tell you that the gaps between what an average investor makes in a fund versus what the fund has generated has been significantly large. This stands true globally, but also in India. And that's purely because of poorly timed decisions that investors have made, in terms of entering or exiting funds or chasing funds that have done reasonably well. Now, all of this can be avoided if you have, you're receiving advice from someone else who's very, very, looking at it from, unbiased view, giving you opinions which are true to you. So I think that's very important. That if you're a newish investor, doesn't understand it very well, doesn't have the time, do not just purely go with direct sort of plans. Think about getting a professional sort of advisor or a distributor who will help you kind of shepherd you through these times and build a portfolio for you. So I think that is one of the key, what I would call a disadvantage, so to speak, of direct plans, because people may get swayed that this is cheaper, let me just go buy it myself, rather than really seeking professional advice, and that can actually be very, very detrimental to your portfolio.
Oh yes, we take that point, and that's why we do have financial advisors across the industry to help you in case you do not want to go the direct way. Kaustubh, we request you to stay on, because we'll slip into a short break, and on the other side, we'll continue our discussion on direct and regular plans and what you should be looking at.
Hey guys, welcome back to Mutual Fund Corner. We are discussing the regular versus direct plan debate, which one is really correct for you, and we still have Kaustubh with us to really help us understand what an investor should do. Kaustubh, we were just going through some of the disadvantages. So considering that if an investor is very new, just getting into the markets for the first time, they should definitely seek professional advice, right here?
Yeah, absolutely, Pavitra. I mean, there are no two ways about it. And, like I was alluding to my earlier sort of, response, that I think it's very important to set the context for investors that, because it's a full-time job in terms of, managing your own portfolio. People may or may not have the time, may not have the, understanding completely about how to construct that portfolio. And especially if you're a first-time investor, and, who's looking to invest for the long term, it becomes very important to seek that professional advice, which can really help you build a portfolio. So even though you're paying, a higher cost to it, there's merit in terms of paying the higher cost, because you will be making better and more prudent financial decisions with regards to investments. And we've seen that, in times like COVID, I think the heartening fact was that when the markets corrected quite rapidly, we did not see significant redemptions away from especially equity funds. Rather, we saw more money moving into it, which is obviously testament to the fact that people are being advised in a very prudent fashion in terms of, really adding up to their portfolios rather than, knee-jerk removing money out from it. So I think that's a very compelling case that, if you do not understand how to invest, don't have the time, definitely seek professional advice and come in through that option. Obviously, there are two ways of doing it. You can work with a mutual fund distributor who would, then advise you to put your money into a regular plan. there is also an alternative way, which unfortunately is not very popular in India right now, but through the registered investment advisor plan, who will guide you towards a direct plan, but will charge you an advice fee over and above that. But that's a choice that investors need to make, when they're looking at it. But definitely seek professional advice. I think that is key. Just going back to the study that I was alluding to earlier, and I think data can tell you some really hard facts. So what the study showed us was that over a 10-year period, investor returns, the gap between the fund return and the investor return was almost 2.8% for all asset classes combined. So investors as a whole lost 2.8% of the overall fund returns purely because they probably ill-timed entry exits, knee-jerk reactions. All of that can be, you can't do away with it completely, obviously, but you can reduce that by using a professional advisor. And I think that's something that investors should definitely look to do. Obviously, if you have the interest and the time, you have the skills to kind of invest on your own, then nothing stops you from doing it direct. You would save on costs, and then but you'll need to be on the top of your portfolio all the time. So I think that's a call that every investor should kind of evaluate and take.
Okay, so in case somebody is switching their investments, they're moving from regular to direct plan or vice versa, what would the implication be for them?
Yeah, so unfortunately, Sonal, that's one of the tricky bits of this whole shift. That currently, as tax laws stand, these are two separate transactions. So you're making a sale, and then you're making a purchase, right? So it is going to be the capital gains element is going to come in, and unfortunately, even though you're probably just you may be going back into the same fund, right? Obviously, there are some sort of safeguards in place in the sense that the LTCG for equities was introduced in 2018 budget. So, we have a grandfather NAV up to Jan of 2018. So only NAV increment, which is also a reasonable amount since then, will be taxed. So I think that's something, the math that investors will need to do if they're making that switch. More recently, even fixed income investments have gone through a taxation change. Obviously, anything that you bought before 31st March 2023 still continues to get the LTCG benefit, but anything after that now goes into the income tax slab. So I think these are contours of taxation that the investors should keep in mind while making that decision. That's one element of it. But more importantly, obviously, the biggest and the most important element is can you take that call yourself? If you can't, then probably better to stick to the direct plan rather than trying to save a bit of cost and getting hit the other side.
Yeah, that could prove to be way more expensive, like you've been pointing
Absolutely.
out. Kaustubh, one final question before we wrap up. What is the kind of direct plan AUM out of the total? Just trying to get a sense of, how much this has contributed, or ever since this was, really opened up. Has this been sort of a big growth trigger for the industry?
Yeah, so two things have happened, Pavitra. So one, if you look at the overall number, and I think AMFI publishes some great stats around this. So when you look at the overall number, I think about 46% of the entire industry AUM is actually in direct. So, I mean, that looks like a very, very significant number when you think about it just, at the absolute, almost half is in direct, right? But a significant portion of that is actually, from institutional clients and fixed income funds. So I think large part of them, obviously, because they're self-directed investors, they're going into the direct plan there. But I think the other thing that we've seen over the last, 4 or 5 years is even retail individuals, have been moving into direct plans. Obviously, with awareness coming in, the advent of platforms, technology enabling it to become easier to invest into direct plans. So I think the latest stat showed about 22% of overall retail AUM is also into direct plans. And remember that, retail AUM is largely staggered towards equity funds. So, I mean, that's a reasonable number, so to speak. But I think, again, every investor should be asking himself or herself that, am I in the right sort of funds? Can I take that call myself, or should I probably be still seeking professional advice, right? But I think obviously it's great that we have both of these options available, and investors have that choice available to them. And I think kudos to the entire ecosystem that's worked hard in terms of we're still at the probably tip of the iceberg in terms of the funds industry's AUM. But we've seen a significant wrap up because all the industry participants, from the regulator to the asset managers, to the distributors, advisors, media such as ourselves, have done this great job in really getting investors aware of the avenues for investing, and what are the pitfalls and sort of the pros and cons of making these investments. So I think we're going to continue seeing this significant leap in both plans, obviously depending on where investor interest lies.
Okay, Kaustubh, it was a masterclass, and thank you so much for joining us today with your take on regular versus direct funds. And with that, we'll take your leave on this edition of Mutual Fund Corner. Stay tuned for Closing Bell to take you through the last hour of trade.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.